Thereafter, however, while the Nasdaq traders traded more shares than NYSE, the dot-com downfall led to a lower per share prices, especially for technology and small company stocks, such that the Nasdaq's annual dollar volume fell below NYSE's. For year 2003, the NYSE's $9.7 trillion trading volume once again engulfed the Nasdaq nearly $6.5 trillion. In further displays of the Nasdaq emergence in the stock market, it has also overtaken NYSE in terms of investor awareness. The NYSE's historical dominance as the market's flagship brand is being challenged by the newer Nasdaq, which, according to one study, even enjoys greater name recognition among the US investors. Now we talk about the placing orders. After doing our research and getting recommendations from our broker, we can choose to place several different types of orders. They can be market orders or they can be orders placed on market price that limit and stop orders, or we can also call it a limit order. And the third one is that the order that differs by size, so the odd lots and the round lots. Let's talk about all three of them one by one. First of all, a market order. A market order requests a broker to buy or sell a certain security at prevailing market price at the time of the order. For example, we can see that on a single day, our broker would have sold our gap stock at a price near $24.15. Next, we can note when we gave order to sell, we did not know exactly what the market price would be by the time the broker goes and sells it. This situation can be avoided with the limit and stop orders, which allows for buying and selling only if certain price conditions are met. So we set a price, we limit the price, we limit and stop the order that this is the price. If you can do it in it, do it. Otherwise, we're not interested. A limit order authorizes the purchaser of a stock only if its price is less than or equal to that specified in the limit. For example, an order to buy at $25 a share means that the broker is to buy if and only the stock becomes available for a price of $25 or less. A stop order instructs the broker to sell if a stock price falls to a certain level. For example, an order of $20 on a particular stock means that the broker is to sell that stock if and only if its price falls to $20 or below. Orders also differ by size. An order for a round lot requests 100 shares of a particular stock or to some multiple thereof. Fractions of round lots are called odd lots because an intermediary and odd lot broker is often involved. Odd lot trading is usually more expensive than round lot trading. Well, next we talk about the financing purchases. When we place a buy order of any kind, we must tell our broker how we will pay for the purchase. For example, we might maintain a cash account with our broker. Then, as you buy and sell stocks, your broker adds proceeds to our account while deducting commissions and purchase costs. Like almost every product in today's economy, securities can also be purchased on credit. Margin trading. Like futures contracts, stocks can be bought on margin. That is, the buyer can put down a portion of the stock price. The rest is borrowed from the buyer's broker, who secures special rate bank loans with stock controlled by the Federal Reserve Board. The margin requirement has remained fixed at 50% since 1974. Margin trading offers several advantages. Suppose we purchase a $100,000 worth of stock in Intel Corp. Let's also say that we purchased 50,000 of our own money and borrowed the other 50,000 from the broker. I'll give you more detail in my next video.